All right, all right, all right, all right. How you guys doing this morning? Everybody's ready to get up and going and running and ready to start doing the seasonal nature of markets. We're going to look at the seasonals today. And Kirk talked about that yesterday in class. He had a few questions on the seasonals. So I thought we would do a class on the seasonals. We haven't done that in a little while. And this is very important for us to be looking at, especially here at the first of the year, coming into January, moving into February. And so we're going to do some 2026 seasonal nature of the markets. We're going to go in and we're going to look and see what type of seasonal trends and cycles we can look forward to here soon and see if there's not any trading opportunities for us. At least maybe put some options on some of them, or at least sell some options and collect some premium. That's what I like to do. I'm not here to tell you what to do. I'm just here to tell you what I like to do. All right. And so I'm going to show you what I like to do when we're looking at the seasonal nature of markets. I've got my software pulled up here. We're going to also go in and we're going to look at the software and see what the markets look like after we determine what the seasonal natures are. So the software tool I use, I'm going to close this little, isn't that a cute little slide right there made by AI? Oh, cute little thing. Little graphics. I love the graphics in AI. All right. So we're going to come in. And we're going to go in and we're going to pull up. The very first thing we want to do is we want to pull up the software I use to do the seasonal nature. Now, we're going to do stocks for the first 30 minutes, and then we're going to do futures for the second 30 minutes. So we're trying to do this in 1 hour, and we're going to look at the stocks version, secret nature of markets, seasonal nature markets, and then the futures version, seasonal nature of markets. All right. So we're going to come in, and I'm going to pull up the software that I've got here. Now I'm going to start with the stock version, and the reason I'm going to start with the stock version is because that's what we've been trading more of lately than the futures market. We've been doing a little bit more day trading, a little less position trading in the futures market. So we'll do the stock market, but then it doesn't mean we can't do position trading, longer term trading in the stock market. In the futures market we certainly can, and we're going to take a look at that, especially with options. And so it might be a little bit easier to understand the seasonal nature of markets from a commodities point of view, even though we're starting with stocks. So let me just kind of throw that out for you, just a quick little idea of what the seasonal nature of markets are. So the seasonal nature of markets have to do with the when it comes to planting crops, it's easy to understand. We plant them at the same time every year. We harvest them at the same time every year. We bring them to market at the same time every year. They're susceptible to damage at the same time every year. Too much rain, not enough rain. They're susceptible to transportation costs and storage fees same time every year. So it becomes a seasonal cycle that goes through each year after year after year. And so you can kind of look forward to these different types of events that cause different types of cycles. And then you can identify, too much rain this year or not enough rain. And then you're going to know how that's going to impact the market. And the market's going to either rise or fall during those time frames. It makes it very easy. Well, easy. Nothing's easy in the stock market, but it makes it easier to help you understand when markets have a tendency to rise or fall in any given season. Now, we do that, believe it or not, with the stock market too. The stock market is very seasonal, believe it or not. The stock market has lots of seasonal trends in it, given the fact that we have the same events that happen all the time. We have earnings reports, we have government reports, we have all kinds of annual reports. We have things that are coming due for Christmas and holidays and all that type of seasonal events that occur in each individual type of stock for different stock sectors and different stock markets. And so we like to look at we can look at the sectors and we can pull some of those up. We'll look at them, but mostly we're interested in individual stocks, individual commodities, and see what they do on a seasonal basis. And then we're going to look and see what seasonally they've been doing. Now we got software that does this for us. So we don't have to go out and get a spreadsheet and sit there and do all the math ourselves and have historical data and everything. The software does it for us. It's called TradeMiner. All right, TradeMiner Pro is the version I have here. And we come in here, and what we do is it's very simple. It's a data mining program. So it goes back and it looks at all the history and it says, hey, out of all the stocks that you've chosen, now I've got a settings in here and I've chosen my favorite stocks. We got just the S&P 500 right now. Now you can choose anything you want, or you can come in and choose one of the pre-selected, like the NASDAQ or the Dow, the exchange traded funds, basic materials. So we got sectors in here that we can go into and look at, like technology and industry and healthcare, utilities, high octane options, larger than $100 per share, less than $100 per share. So we can have all kinds of different things there. I'm just going to use the S&P 500. So 500 biggest, best stocks of the stock market. That's what we're going to be searching, but it doesn't mean that there's not other stocks that are seasonal outside of the S&P 500. We're just going to use that as our starting point, all right? And so what it's going to do is it's going to go through and it's going to search for all of the stocks that have high seasonal natures to them. It's going to do this data mining, all right? And it's going to try and find all the stocks that have seasonal reoccurring trends. It does it for us. It's really cool. So we're going to come in here and I can search this by month or symbol. I can come in here and do individual symbols and I can say, hey, show me the seasonal nature of Amtrak right here, Amtech or Amgen, or show me the seasonal nature of Bunge or American Express, right? You want to see the seasonal nature of American Express? You can pull up American Express and it'll show you where the seasonal trends are for that one stock. But I like to do it this way, all right? I like to come in here and I like to come in and I like to go to the month. And I like to say, well, we're in the month of January. We're actually headed into the month of February. So, well, we're only into, let's do January. Let's do January because we still got some January timeframes left. So we're going to go from the month of January. Now, I like to just look at the entire S&P 500 and find out if there's any stocks in the entire S&P 500 that have highly correlated seasonal natures to them. All right, seasonal reoccurring price patterns and trends. And so it's going to tell us, and I want to have it tell me, this is it's just a little AI type system here. This is your prompt, all right? So you come in here and you go search for trends in the month of January, find trends that have won at least 80% of the time. All right. Now, it doesn't mean it can't do more than 80, as it can do more. It just can't do less. Go 80 and 90, 100% of the time. So find trends that have won at least 80% of the time. And showing, let's just do bullish. All right. We're only interested in markets that go up. So let's do bullish on this one and list trends that last at least 10 trading days, but no more than 25 trading days. So we're going to go kind of in that 1 month time frame. So we want like a 30-day time frame. The reason I have it set to 10 and 25, I want it to be, I don't want little tiny short moves. It's got to be at least 10 days long, a 10-day trend. That's the shortest. But I don't want it to go 2, 3, 4 months long either. I want it to be kind of stuck in that 1 month time frame. And the reason I do that is because I like to trade options on them. All right. So I like to sell premium, collect premium, selling covered calls or cash secured puts. And so that's why I like to do that. So it's kind of almost like, I get a paycheck every month based on my options selling and collect those premiums. And so I want to do that so it's within that time frame. All right. And then we find at least 12 years of history. Now, again, 12 is the minimum. It can go much more than 12, but we don't want it to be 80% of the time within at least a minimum of 12 years. Okay. So, and then we're going to remove the same symbol duplicate start dates and remove the same symbol overlapping dates. These are just filters to help us not have so many duplications in there. You get 1 or 2 days off and then it still has this seasonal trend in it. So we just kind of eliminate those. All right. So then we just hit search and we have the system go out and it searches the entire historical database of the S&P 500 and it tries to find for us any correlations of seasonal trends. So there they are. Holy cow, there's a bunch of them. It found a bunch of them. Okay, it found 479 reoccurring price patterns. I told you that the stock market was very seasonal. All right, now some are going to be much better than others, and the software already goes through and kind of helps us rank them. We have this little score here, and this is a score that you can it's kind of user definable. You can come in here to the settings. Is it the setting? Where is it? Oh, let's see. Back out here, over here, preferences. All right. And in here, you can kind of set the score weighting right here. See this down here on the score weighting? It says volatility return is set at 35, average return is 15%, accuracy is 15, drawdown is 35. And you can change those around, but they always need to equal 100%. So that's your score. And that's just the default settings. That's the ones that we've done a lot of historical back testing on and discovered that that's pretty good. That's about the best you can do. All right. But there's all kinds of stuff in here you can change. So you can come in here and you say, when selecting trades for my finished portfolio, I would like to optimize using the following: minimum risk, maximum risk, or minimum risk and maximum return. That's what I have it on. That's the default setting. Then you can say optimize when I auto select to build my portfolio so that it will try to keep me in my max trades at any one time. You can turn that on and it'll help you maximize your existing trades. I'm going to turn that off because I want to decide myself. All right. And then we're going to say my account balance is $250,000. You can put that at whatever you want. It just helps you know how many shares you can how many shares you can buy of each individual stock based on the size of your portfolio. But for us, we're just going to make a big number, 250,000. So we're not restricted by saying, well, I only have a $10,000 account. So, okay, well, put $10,000 in there and it'll tell you, well, you can't buy this one. You can't buy that one. You can buy these. You can buy those. All right. Oh, you want to buy 2 more. Sorry, you can't. You don't have enough money. So it does that kind of thing for you. But we're just going to put it up there to a big number, 250,000, and we'll leave it there. All right. So that's kind of how it goes. All right. So now we're going to come back over here. And we're going to come in and we're going to go through and we're going to look at the score. Now, just because it has if we come down here a little bit farther, you can see we have lots of greens, we have yellows, and then if we keep going, we have reds. Now, that's the score. Just because it has a red score doesn't mean that it doesn't fall within the category above. So the category above tells us the month that in this month of January, 80% of the time over the last 12 years, this stock, even though it's a red score, has still met that criteria up there. All right. So Hormel Foods gets a 1.0 on the score, but nonetheless, between January 30th and February 19th, 81% of the time over the last 31 years, 21 calendar days, it's returned a 3% annualized return. That's not a bad trade. All right, 3% annualized return in 21 days, and and it's done at 81% of the time over the last 30 years. That's crazy. All right, that's pretty damn good. Now, if you look at the last parts of it, this is where it's done that. You can see the last part from 2018 to 2025, not so good. All right, not so good. And that's why the score is low, because it went in and scored it and it said, hey, you know what? We take a look at what's been going on recently, more so than what's been going on historically. And Hormel, well, not so good. So it gets a low score. All right. So what we're going to do is we're going to come back up here and we're going to look at the high scores. All right. It's going to already help us a little bit. So if we just let's just come in here just for fun. All right. We're going to take this out of step 1. This is the search step. And we're going to come in and we got so many of them, we can't look at them all. Actually, let's just grab the ones that got all 5s. All right, let's just grab all the 5s first. How about that? We just grab the 5s. Or actually, let's do this. Let's come in and we'll just grab all the greens. All the ones that got green score. How about that? Take all the ones that got the green score, and we're going to move them over to the neural network. So we're going to come in here and we're going to add to step 2. We click on that. And that brings us over here to the neural network. There they are. They're all in this next second tab. All right. Notice that it's very easy to use. We got step 1, step 2, step 3, step 4. We got trade alerts, settings, and education. That's all there is to it. Very, very simple. So we come in here, we do the search. Now the neural network has the ability to go through and it creates what I call a fingerprint. So what it does, it goes back in time and it looks at every single year and creates a fingerprint. And then it comes through and it says, does this year's fingerprint look like winning fingerprints or losing fingerprints? So then that's where the neural network comes in. If you guys wanted to have ChatGPT help you trade, well, that's what's going on right here. This is a little neural network system that goes through and goes back and looks and sees, well, is this year looking like winning years in past during this time frame or losing years in past during this time frame? Now, in the interest of time, I'm not going to click that button because we'd be here for the next 15 minutes, and that's all we've got, waiting for it to calculate all these trends. So what you can do is you can eliminate some of these and calculate them, and it takes, you don't have to calculate all of them. And it's not going to calculate all of them because some of them it says, within 5 trading days, and the maximum I think you can go out and look is within 15 days. So that means it's got to try and look out 15 days and create a fingerprint and then see if this looks like that one. And the closer, of course, you get to the current day of trading, the more accurate it's going to be. So, you really only want to go out maybe 3, 4, 5 days. And then, of course, right before the day, you run it again, let the neural network look and see and say, well, it's really not performing like it was last year. It's performing more this year like a losing trades, or it's performing more this year like winning trades. It'll give you a higher or lower score. All right. So maybe we'll do that on a few, but let's come in here first and eliminate some of these. First of all, you can see over here, because we are in January and January's already started, we got some trades that are going. So you can see it's already closed out. $80 winner there, 620 winner there, 153 winner there, 1,300 winner there. That's the close price. That's not actually, that's the profit and loss over here. Okay, 448 here. This was a $1,300 loser. Hopefully you were using your stop loss orders and not letting it just, don't let these things lose. That's the whole idea. It's just like any other trade. These just say, well, between this date and this date, did it make money? It didn't use any technical analysis or risk and money management, or we like to do that stuff. All right. This is just straight up in and out. So $450 winner at 139.61. There's a $900 loser. There's a $1,200 winner. 29. So some of these are still open positions. So we got 96, 487. There's a negative 300, negative 300. There's a winner. Skyker is up $1,600, up $1,100. There's 570. There's a loser, 742, 22. There's a winner, 2,000, 146, 239, 178, down 780. So not all of them win because some of them have, counter seasonal trends this year. So you have to be able to read your charts and not just say, well, it says get on January 2nd, get out January 26th, and then just run it hardcore like that. It's easier to kind of just say, okay, this is where a seasonal trend is. It scored high. Let's go look at the chart and see if we can get in and take advantage of the rally. And if it doesn't rally that year, well, you want to be able to be smart enough to use a stop order and get out and not take a $1,300 loss on it just because, well, seasonally said it's supposed to go up. Well, it's not going up this year. Use a stop loss order and get out. All right, take a very small loss. All right, so that's how we do it. But those are the ones that are actually active right now. So we don't want any of those. All right, so we're going to sort by date in here. And we're going to get rid of everything up until, well, all the blue ones are no good for us because they've already started. All right, so let's just kill all those. That makes that easy. Gets rid of all those. Boom. And we're just going to remove those. Okay, so we got rid of all the ones that had already started. Now we got what's going over. Okay, so starting January 8th. Now we're going to sort again by score. Actually, we sorted by score. We got all the big ones in here. Let's come in here and sort by winning percent. So the ones that make the most money. There's one that made 100%. Our winning percent ratio, 100% of the time, NVIDIA between January 15th and February 18th over the last 14 years has averaged a 12% annualized return. So starting January, but that's January 15th. That's not today. It's not tomorrow. We have to wait a little bit. But between January 15th, February 18th, 100% of the time over the last 14 years, NVIDIA has returned an average of 12% annualized return. Well, that's something we're going to want to watch. All right, we're going to want to pay attention to that. All right, the next thing is we've got Hilton Worldwide Holdings. So Hilton, January 14th through February 17th, 100% of the time over the last 12 years, 35 calendar days, 7% annualized return. And it got a score of 4.51. All right, so we're still just doing all the green scores. So let's come in here and and this is all the high returns. So let's go down. Let's just grab all the ones. And we got a third step. We're going to put them over here in the pick list. So let's come back here and let's just grab these ones that have a really high return up 80. Let's just grab 89, up 92. Let's grab these two 89ers. We'll grab that one. Lennox International. How did it do? It had a low return, 5%. Let's leave that one out. It's 88% annualized return. We'll see if it shows up in something else. So we're going to grab those and we're going to add those to the pick list. All right. So those are added to the pick list. So now what I'm going to do is I'm going to remove the selected. So they're not here. Oh, when I took them out of there, it takes them out of the pick list. Oh, doggone it. I got to put those back over here. Add to step 2 because it goes progressively. So I got to put them back in. All right. So get them over here to the pick list. We're going to take the first, these right in here. So we're going to grab, what do we say, down to 89. Okay, so now we're going to add the pick list. All right, now we're going to sort by years. How many years? Oh, I like them when they've got a lot of years. All right, other guys are like, no, I just like the last 10 or 12 years most important. I don't care about how long. I do. I like a lot of years. So we're going to come in here. Look at this. Some of these, this is 45 years. This is 45 years. Look at that history on that. 48 years, 45 years, but they got low average returns because the further back you go, the lower the average return is, right? Because you got more prices to take into consideration. But I like lots of years. But some other guys, they like to come down here and they like to do it the other way around. They don't like lots of years. They like the shorter years because that means the last few years are the most important. They've really been doing well in the last few years. So it depends on how you want to do it. All right. Let's take a few of the 12. These are all 12s. Ooh, 12 years. So let's go the shortest ones that are 12 years. Okay, so we'll take all those, add those to our pick list. And we're going to come in here and let's go by average profit. We want to, which ones are making the most money? Well, let's go down to, let's just grab the ones that are making 10% annualized. Oh, 9's good. 9% annualized return. That's in like 20 days. 9% annualized return in 20 days. That's a lot of money. We could go down and we could take, well, let's just take those. We're getting plenty in here. Add to pick list. All right, we're going to take those. Now we're going to sort by score and just take all the 5s. Let's take all the 5. Oh, well, we got all the 5s. We got all the 5s already. Right? So that's a good list. That's how we're going to skinny this thing down. Now, when we come over here, you can see in the portfolio, the pick list, well, we still got quite a few. We got a lot in here. All right, so we can now sort them. We can say, well, look, here's all the scores that are 5s. If you wanted to remove some out of here again, because you're like, man, I got a lot of them in here, you can. But these are all bullish trends. These are all the symbols. These are all the company names. We got the start dates. We can sort by start date. So it says January 6th is the first. The very last one is January 30th because we're just doing the Januaries. The win ratios, you can see which ones have won 100% of the time, 100 all the way down. Years, how many years they've gone back. We didn't do we didn't do the long years, did we? We didn't do the long years. Should we go grab a few long years? Let's see, 45 years. Let's just grab those 40 years. Let's grab those and add those to our pick list. Now we'll come back over here. Okay, we've expanded our pick list even bigger. Oh, pick list is getting long now. So now we got some 45 years in there. We got some calendar days. We got average profit. We can sort by those. Biggest one is 13% in 20 days. That's a lot of money. Let's see what that is annualized. It doesn't tell us annualized. We have to calculate that to be annualized. So we're going to take our little calculator and we're going to say 365 days divided by 20 days equals 18 times 12. That would be about a 219% annualized return. That's killer. Holy cow, that's a lot of money. All right, average profit in that period of time, $3,300 with a $25,000 investment. And consumer sector, this is the industry. And oh, look, we still got a few in here that are already active. So let's kill those. Not all of them, just the ones that are active. All right, so we're going to remove those. Remove selected. Oh, we got some more active ones in here. Looks like when we went back and grabbed some of the, we don't want those. Remove selected. Okay, so now we just got a clean list. All right, now this part of the neural network comes in and it helps us pick out of this list which ones we want. All right, so it says, I would like to be in no more than 7. Now we're going to come down. We're just going to pick one at a time because we can just pick the very favorite one and then the very next favorite one and then the very next favorite one. So we're going to do that. All right, so I would like to be in no more than 1 trade total. Therefore, based on my current portfolio, which is we got 25,000 here, I'm able to add up to 1 additional trade. I would like to add 1 additional trade now. When auto-selecting trades for your portfolio, only include trades where the probabilities have been calculated, yes or no. Now, we haven't calculated any of these probabilities. We'd have to come back over here, and we'd have to sort by the add. We want to do that. And we would take all these out like this, because we're not going to trade these. And we would remove those selected. So we want to remove selected. Now I have just the ones that we got in our pick list over here, which are these right here. That's the same list now. Now, if we wanted to run, and we could say, let's just run the ones that are within the next 5 days. Let's do next 3 days, just in the interest of time. All right, calculate now, because it's going to take a few minutes for it to run that. All right, it's done calculating the ones within the. So now this tells you the probabilities. 1 day calculation. Let's see. Oh, we haven't got any in here that calculated. It took that long to tell us it's not going to calculate any of them. So 1 day till calculation. So let's go up to 5 days. See if we can get 6 days. We'll see if we can get these top 3 at least to be calculated. It's going to take a few minutes here to calculate them. Now what it's doing is it's going out, it's creating fingerprints for every single year. All the winning years, all the losing years. And then it's going to look at this year. And it's going to say, okay, what does this year's data look like? It's going to create a fingerprint. It's going to look at that fingerprint, and it's going to compare it to all the past history. And it's going to say, does this year look like, what's the probabilities it's going to be a winning year or a losing year? And it looks at all of them and gives you a probability. Now, here it comes in with probability. So it went back 6 days, and it says high probability, high, 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 medium, low, low. So if you want to take the low lows out, you can, all right? So we could just come in here and we just grab these 2 lows. Maybe we'll even take the mediums out, right? Since we got so many. All right, we'll take those out. And we'll just say, okay, we're going to remove the selected. Just take those out. All we want is the high probability that it's going to be again this year. Okay, so now when we come back over here to our portfolio step, look at this. We've got them in here. Now, are we going to just based on, because they're not all calculated, I'm not going to do that. So when auto-selecting trades for your portfolio only include trades where probably has been selected, I'm going to say no. All right, because we only have like 1, 2, 3, 4, 5 out of the list that have been calculated. So what I would do if we were going to do this, we would just say, well, let's just get rid of everything else, leave it over in the neural network section, just bring the ones that are over here, and then have it select out of just those that are the probabilities. Or you can just say yes, and then it'll select the favorite one out of the ones that have been calculated probability. Let's do that. We're going to take the favorite one out of just the highs here. All right, let's do that. So we're going to auto select. And it says out of the ones that you've run the neural network on, this is my favorite. So its favorite is Palo Alto Networks, January 15th. Now remember, this is an AI system that's going out and doing all this analysis. You wanted AI to help you trade? Here it is. It's helping you trade. It's saying, I want Palo Alto Networks between January 15th and February 17th. It says in the past 13 years, 92% of the time, this thing is returned on average a 10% annualized return. So 10% average return. So that means if that was annualized, that would be like 100%. So 10 times, it'd be actually more than that, 120% annualized return. With an average profit of $2,500, it's a technology sector, communication equipment. All right, and the trade starts on January 15th. So between January 15th and February 17th, so it goes over into 17, but it's 34 days. This market has returned a 10% annualized return 92% of the time. All right, let's go look at it. PANW. So let's go look at PANW. All right, so this is my charting software. So I'm going to come in here. I'm going to create a new portfolio. I'm going to call it Seasonals. And I'm going to call it January 2026. All right. Okay, so our Seasonals was PANW, right? PANW. All right. PANW. Pull it up. It's one of the S&P 500s. There it is. That's what it looks like. And it looks like it's getting ready to rock and roll here, doesn't it? It looks like a good trade getting ready. It's down here below the 50% annual or the 50% Fibonacci ruler. Even on this last run, it's way down. It's had a nice pullback. This is a good stock. We like this one. All right. So what are we going to do? How are we going to trade this? Well, the seasonal nature of this market doesn't start until January 15th. And today's the 8th. But it looks like it's getting ready to go. But that's the 8th, the 15th. So we could wait until the 15th, which is going to be right out here somewhere. We could wait a few days. It might have a little bit of a pullback. Or we could just come in here and we could sell an option. Now it's rallying today, so we might want to wait for it to give a little pullback. And then we come in here and see if it's got any options. If it doesn't have any options, then we're going to kind of be disappointed. We come out and do 43, and we could, oh, it's got good, not good, but it's got decent options. It's got open interest. Well, look at the spread on that. It's $35. 0.4%. All right, so we're going to come in here and let's sell one of these. Where are we going to sell it? Maybe we'll sell it right here. All right, so we're going to receive $517 to sell that option. And if the market comes down and actually closes down underneath here, we're going to end up buying 100 shares of this. All right, which would be 100 shares at, it'd be $18,000 because it's $180 a share. So you're going to have $18,000 to buy those shares. So if you're like, well, I don't want to buy the shares, Lan. I don't have $18,000 to put into this stock. Okay, well, don't just do a cash secured put then. Then you could risk a little bit and then just come in here and say, well, I'm gonna buy a put right here. So you're going to buy the put. And then that gives you a 28% annualized return. Margin requirement is only $500. So they're going to margin you at max loss. So the max you could lose is $500. All right. You're going to receive 140 instead of the 517 because you're buying insurance. This is an expensive insurance policy right here. So you could drop it down and buy a little bit of less expensive insurance policy, but then you're going to need more margin. Now they're going to margin you a requirement of $1,000 because you didn't buy as good of insurance. So if you crash and burn, well, you have to pay a little bit more of your own money, right? That's what this is. You're going to say, I'm going to buy this and I'm going to sell this. I'm going to sell it for $517. And I believe the market's going to rally. All right. And if it does, you're going to keep your $517. But if the market doesn't, if it comes down here and touches that purple line underneath the red line, well, you have to buy 100 shares. That's all it means. You just buy 100 shares and then wait for it to go back up later. All right. Not a bad deal. But if you don't have the $18,000 to buy the 100 shares, then you have to buy insurance so that you don't have to buy the 100 shares. But if that's the case, then you're going to have to collect on your insurance policy. And anytime you buy an insurance policy, you also have a deductible, right? So you can determine how big your deductible is. Well, right now we've got our margin requirement. That's the deductible, $1,000. They're going to margin you at your max deductible or your max loss, so $1,000. Now you think the market's going to go up, so you say, well, I'm willing to take a bigger deductible. So, oh, well, I don't think the market, well, you know, pull it down a little farther. Well, now you got a deductible of $1,500. But that means you're going to make more money. See, now you're going to make $327 because you're not spending as much on insurance. Well, I'm going to pull it down here a little farther. Okay, well, now you're going to get a deductible of $2,000. You're going to have to pay yourself. They're going to margin you again at max loss, $2,000. That's your deductible. So now you got a deductible of $2,000, but now you're going to make more money because your insurance is less expensive. Your insurance is only $128. And you're going to receive $517. So now you're going to receive $389 for putting this on. That's your max profit. All right. So you set a max profit and you've got a max loss. Max loss is $2,000. Max profit is $389. And you have a return on risk of 19%. That's 19% in 43 days. That's a lot of money. 19% in 43 days. Again, how many 43 days are there in a year? It'll tell you your annualized return. 365 divided by 43 equals about 8.5. So we'll just say 8. 8 times 19.45 equals, that's 155% annualized return. That's a lot of money. Ooh, land, I don't need that much money. Okay, well, dial it down a little bit. You can pull your insurance down here, but you can also pull your purchasing down here. So you're not making as much, which means you're not making as big a return. So you can say, well, I'm going to take 190. There's 271 down here. So now the market has to touch the purple line underneath your red line. And then if that's the case, then you buy the shares or you cash in your insurance policy, and which is you paid $1,500. You're going to, well, as much as $1,500. It's not the full $1,500 until it goes down here, right? Underneath the green line, then it's $1,500. If you push the green line up, well, now it only has to go here, and now you have $1,000 deductible. Go up here, see, better insurance. Now you only have $500 deductible, but of course you're paying more money for insurance, so now you're only going to receive $81 because you're paying it all in insurance. All right. Bring it down here. Now you got a bigger deductible, $1,000 deductible, but you're going to make more money, $143. But that's if the market comes down. Seasonally speaking, this thing has gone up 92% of the time over the last 13 years. 92% of the time over the last 13 years during the time frame of January 15th to February 17th. That's how you trade. All right. That's how you trade. That's how you trade these. Or you could just come in and buy a call. You know, why not? Hey, I just can buy a call. There we go. Now you got a call. Now, of course, we put them both on there. Now we got a call and a put. So we got a call and a put. We're going to sell a put. We're going to have some insurance premium to the downside. And we got a long call that we're going to put in there, and we're going to make money to the upside. Now you really make some money. All right. $1,214 what you're going to pay because you got to buy that insurance, but you're getting you're got to buy that long call, but you're also receiving $271 in premium on the put, and you're buying an insurance policy for $128. You put that all on one ticket and send that off. You're going to pay $1,214, and you're going to be making money, boom, if that market goes up. That's how you do it. That's how I do it. I'm not telling you what to do. That's just what I do. All right. That's just what I do. All right. I'm not telling you what to do. I'm just telling you what I like to do. Now, you can also put a bull call spread on here. Let me show you another one. Another nice little strategy. Let's hit cancel on here. We come in here, and you could just come in here, and you buy a call just like that. And you say, well, I'm going to buy a call, and you're going to pay $1,357 for it. Or you can push it up one more little click, and you can pay $1,000. Let's just leave it at $1,000. So you're going to buy a $1,000 option. All right. So you're going to buy that. And then you're going to come in here and you're going to sell a call up here farther. And they're going to actually give you money to do that. See that? So you say, if you're willing to sell your call option, your shares at that price, once you got them, right? Because you're going to buy them here and you're willing to sell them there, Well, they'll give you $362 to sell them right there. But land, what if they go higher? What if they go up here? Well, then you don't get to make all that money, but it's like it's like buying the shares and putting a limit order to take your profits. Once you get out, you don't worry about how much higher it went. If you want to, you can get back in. But this way, they're going to give you $362 in cash against your $1,000 in cost. So you can see over here, you're only going to pay $712. That's a lot less than $1,000. That's $300 less because you're getting $362 right here on this one that you sold up there. All you're doing is saying, I'm going to buy it here and sell it there. And you get the difference between what's between here. So you make this much money, $2,000 plus $362. You can make $2,362. That's how it works. If you're like, Lan, this sounds really cool, I want to do some of this. Well, just keep coming back to class and we'll teach you how to do it. We'll just keep doing it over and over and over again. And then you can practice it. Get your software. It just takes software. It just takes the right software. Just get the right software. Go out there and get yourself this software so you know when to do this. That's the biggest important thing. And then come and get this software so you know how to do it. All right. This is where you place your orders. It's just a carnival game. You're just going to come in here. Well, I think the market's going to go up. Well, if you think it's going to go up because, well, that's what it's done over the last 15, 35 years, the last 14 years, it's gone up 100% of the time. Well, maybe we ought to just put an option on there. Make some money on it. And if we don't, we take a risk, we lose some money. There's always a risk of loss. All right. You just try to minimize the losses. All right. That's it. That's the name of the game. That's how you trade. That's how I trade. I'm not telling you what to do. Just telling you what I like to do. All right. So let's come over and do it again. Let's look at a couple more. Now, we're not going to come and do all that analysis because we want to go look at the futures market. So this is now, I'm kind of giving you a little, take a screenshot of these. You know, you can go look at these. Get your little camera out while I've got them up here, done all this research for you. Grab your little camera and go in here and take a picture of all these so you can go look at them, do a little research on your own. There you go. I've done all the hard work. Now let's have the AI system tell us which ones it likes best out of these. All right. Let's turn off this. Let's not just say just the ones that are in the that have had the probability, because there's a whole bunch of them down here that we haven't calculated probabilities on. So let's see what out of this whole list. Let's put this back in. Let's put this back up in there. How do we do that? Remove selected. Okay, so it's back up here now. So now what we're going to do is we're going to have the AI system pick out of all these, that not including the ones that haven't been calculated. All right. So we're going to say, when trading, include probabilities have been calculated. No. All right. So we're going to hit auto select. This is out of this whole list. This is the AI system's favorite one, not counting the probabilities. All right. And there it is. Interactive Brokers, IBKR. And 12 days till calculation, January 27th to February 17th. 89% of the time over the last 18 years, it's a return 7%. So that's the favorite one out of that whole list. Let's go look at it. IBKR. They're a brokerage firm. IBKR. So we're going to go over here to charts. We'll pull up a real quick IBKR. All right, there's Interactive Brokers. Now, the problem with them, now, again, this isn't until January 15th, so we need a pullback. So it's 8th right now, 15th, only out right here. So let's watch, because it's kind of rallying right now. So we need a little ABC, and then we're going to say, well, that's when it's going to go. So let's wait for the little pullback. And when it gets the little pullback in there and it starts getting the 15th, watch close, because that's when you're going to want to come in here. You want to sell a put. All right, now we're not going to want to do a 1-day put. Let's do a 43-day put. We're going to sell a put. We're going to sell the put down here if they do puts. That's not so good. A little disappointing. Open interest is low. Probably not going to do an option. You're just going to have to decide if you want to buy some shares on the pullback and watch the rally. All right, so that's Interactive Brokers, but they've got a good seasonals. There's just their options are not that great. Let's do another couple more. Auto select. Oh, we need to add it till we want two, and we want one more. Okay, so there's the second one. Bookings holding between January. That's clear at the end of the month. January 29th, February 20th has this next favorite one. BKNG. Let's go look at that one. Charts, BKNG. BKNG. Oh, wow. That market's really on the tear already. Had a good opportunity back here already. But it's gone up, We're going to look for a little pullback. It looks like it's getting a little pullback and getting ready to break and make that next rally. Maybe what it's looking for is going to get a little head and shoulders in there and then a little rally out in here. I don't know. But it says it's not until the end of the month. So that one we got till January 29th. So it's going to make some moves out in here before we want to go seasonal on that one. All right. But it's still bullish. I mean, you can still come in here. I don't know. This thing's going to have no options. Like options are nothing. Nobody wants to trade it because it's huge. $5,408 per share. Who wants to trade that? Not me. So what we're going to do is we're going to kick that one out. We'll just come in here. And we'll go remove selected. We don't like it. Where did it go up here? Bookings. And we'll just kill it out of here too. Remove selected. All right. We don't want that one. Okay. Now we're going to say, I want two. Give me two. Auto select. Okay. There's our two favorites. Wait a second. I thought I just killed booking. There must be in there twice. Remove selected. Bookings. Move that one too. Remove selected. All right. Let's try this again. Okay. Auto select. We'll do one more. Okay. There's our Palo Alto. So it picked Palo Alto again. Even though we said pick it out of the not having the ones that have the probabilities already calculated. So let's do one more. I know we're going to do one more. Let's do 5. Okay. We'll just tell it do 5 and we're going to do, we got 2. We're going to do 3 more. We'll do all 3 of them at once. All right. That's the favorite ones. Okay. So what you're going to do, take your little camera, hurry quick before I take it away. Take a picture. These are the ones that it likes its favorite ones out of that list, but it doesn't mean that they're not all good ones. I mean, they're just different timing. This is the one that the AI system liked best. All right. And of course, 1, 2, 3, 4 of them have their probabilities calculated. So it probably took that into consideration. This is one Interactive Brokers that it said 12 days till calculation. Now I'm going to tell you what I do. I'm not going to tell you what to do. I'll tell you what I do. When I look at one of these, if it tells me that the seasonal nature of the trend is, going to happen during this time frame, if it doesn't correspond with my strategy, I still don't take it. All right. I still want it to be part of my technical analysis strategy. All right. I want to look at it from this kind of this rally standpoint. So you can see right here, this market very much followed this pattern. Okay. I had this accumulation stage. I had the nice little rally, had a few ups and downs. It went across the top. It's coming down off. Oh, come back here. And then it came down off the top like this, and now it's going sideways, and now it's breaking and starting to go rally up again. So this is the accumulation distribution model by big brokerage firms and banks and hedge funds. So that's how this market is rolling. So I want to make sure that when my seasonal trend falls within the category of what's going on here, and it still follows the mapping of the Wyckoff accumulation distribution model and the ABC patterns, the recurring price patterns, the head and shoulders, necklines, all that kind of stuff, all those trend line stuff that we do. I still want those seasonal patterns to correspond with that. And if it doesn't match, if I don't get a matchup, I don't trade it. All right. Just because it says seasonally speaking, it does it. And then it's like way high already. And it's like looking like it's going to pull down. I ain't going to take it. All right. So keep that in mind. I still use all my technical analysis. I still use my brain. I still use my education that I've learned on how to trade against these seasonal trends. Okay. So that's how I do it. And now this is the stock market version for January. So let's go and look at let's close this out. And we're going to close this out. Well, we'll close that out. And this is the stock market. So I'm going to hit save. We'll save all those. And I'm going to close that out. And we're going to come back. Now we're going to go look at the futures market. All right. And so I'm going to pull up the futures version of Track and Trade so we can grab those. Let's go into this one. Give it a second to pull it. It'll pull up in the background. Oh, there it is. Okay. So we got the futures version of the software. And now we're going to pull up the futures version of TradeMiner. All right. So TradeMiner, we're going to go back to search one. So we're going to find and select high probability trading opportunities for your portfolio. Search for the month of, and again, we're going to do month. And we're going to say, we're going to do January. I'm going to go into settings and see what I've got. I've got my special list. This is my list. This is a list that I have decided that I want to have in my list, things I like to trade. Things I don't want to trade, I've turned off, like oats. I don't want to trade rice. I don't want to trade rice and oats. So I've turned those off. All right. I don't want to trade US T-notes, 5-year T-notes. I've turned those off. I don't want to trade sugar. I've turned that off. I don't want to trade canola or orange juice or Brent crude oil. I've turned those off. Wheat, the MJX wheat, I've turned that off. All right. Because I got the other kind of wheat. Oh, this is KCBT wheat. I've turned that off. All right. Hogs, lean hogs. I got those turned on. Silver, gasoline, platinum, palladium, oil, natural gas. These are all turned on. There's some that I've turned off. I've turned off cocoa, cotton, US dollar, mid cap, Swiss franc, the Japanese yen. I've turned off the Forex for foreign currencies, Australian dollar, British pound, Canadian dollar. We're not searching all those. All right. We're just searching the very best commodities in here. And I don't even think I've got there's wheat. I've got wheat turned on down here. This is the CBOT wheat. I don't think I even have in here. Do I have oh, I do. I have the Russell turned on, the Dow, and the U.S. Treasury bonds. I got 30-year treasuries. I just got 5 years turned off. We could put 5 years on. 5 years. Oh, yeah, we'll leave the 5 years off. We like 10 years. All right. So there you go. There you go. That's what we're going to be looking at. So we're going to come in here and we're going to go the month of January. What's good in the commodities market? Find trends that have won at least 80% of the time. So we're going to do both. Should we just do bullish or should we do bearish? It's really easy to take short positions in the futures market. So we're going to do both, longs and shorts. List trends that last at least 10 trading days, but no more than 25. Now, this is a longer term time frame. 25 days is in the futures markets, like growing mold, right? So we could skinny that down. We could say 7 to 10 days, 7 to 15 days, maybe 2 weeks, right? Trading days, find at least 10 years of history, and then remove same symbol duplicate start dates, remove same symbol overlapping trade dates. And then we're just going to go search on that one. Let's see what it does with 7 and 15. We may change it. All right, let's see how many greens we got. We got a lot of greens. Okay. Let's go to the neural network is empty, portfolio is empty. Let's come back here and do the same thing. We're going to just grab a bunch of green ones. Let's just work with the green ones for now. Doesn't mean they're not, the yellow ones and red ones aren't bad. They're just not as good as the green ones. We got lots of green ones, so we might as well just work with the green ones for now. So we're going to add those to step 2. Come over here to the neural network. And let's see what's going on in the futures market out of Chicago. All right, so we're going to sort by score. Let's bring the score up high. So we've only got one fiver, and that's the NASDAQ. All right, between January 29th and February 17th, 83% of the time over the last 18 years, 20 calendar days, it's averaged a 24% return on margin. All right, 20% ROM. And then we got an average profit of $4,600. That's pretty good. So we want to be mindful of that one. All right, that's got a 5 score. So we can add that one to our list. Now let's come down the next one. These are all NASDAQs. NASDAQs all have good, right there. Look, they're all the same. 27, 28, 29 days. They're all within the same. So we could just use the one that starts at 27 because it encompasses both of these. Not the exact same. So let's just take this one because it's 1 day earlier. That's the NASDAQ. We got another NASDAQ down here, 27 to 17. That's the June contract. We'll have to just look at the one that's the forward month contract, but it looks like NASDAQ at that time frame is a good one. All right. So then we're going to come down here and let's look at the start dates. Oh, we've got some that are already active. That one's already up $1,000. That one's already up $400. Let's take these two out. Let's see, remove selected. Okay, take the active ones out. All right, so we're going to come in here and years. Let's look at how many years back. 88% of the time. We like anything above 80. So we'll take all these for now. All right, we'll just take all these. And we'll add those. Add to. Oh, this is the neural network. Yeah, so we're going to add those to the pick list. So anything above 80%. So we're going to go years back. We got years. So these are all high years. Well, that's good. And then we're going to do high percentages. Any with high, oh, look at that, 46% average return. We're missing some of these, like hogs. 40, 40. That's 42. Let's take these. Add those to the pick list. All right. So I think that's good. I think that's good. Let's go over and look at our pork list. Our pork list still got a lot of stuff in here. That's all right. Out of all those, we're going to have the neural network tell us which ones. Now, again, I haven't done any of the calculating the probabilities on any of these. All right. We could do it. We could do it on a couple of them if we wanted to. We could come in here. Let's sort by this. Let's see. What's our dates? Oh, these are all. Well, let's get rid of all these. We're not going to take those. Remove selected. And let's just do 3 days out. We're going to calculate, see if there's anything in there. 3 days out. I don't know. Do we have anything 3 days out? I don't think we even do. Maybe a couple. 8, 9. We got a couple in there that are 3 days out. Okay, so we're just calculating the probabilities. Oh, and look, if we put the probabilities, this is medium, low. Silver and gold, both of them low, but that's between January 12th and February 2nd. It doesn't like the fingerprint. January 9th, January 27th on gold. And then corn is very low probability of being successful between January 12th and 28th. So you go look at that and say, well, if it's got a very low probability of being successful, we might want to buy some puts or at least sell some calls against it. That's January 12th. Let's go look at corn. Okay, so we're going to come in here and we're going to come down to corn. Corn, chicken and corn. All right, that's what corn's looking like. That's a daily chart on corn. That's March corn. Let's come in here. Let's turn off this little ATR. Let's turn on bulls and bears. Ooh, this thing's just dead, isn't it? Yeah, that's probably why it doesn't like it. It says, doesn't look like it's going to go anywhere, guys. Pretty dead market. So if it's a dead market, we could put on here, you know what we could do? That's the expiration. Let's see if there's any options on this March corn contract. Are there any options? There's a few. The open interest is nothing. Oh, that's the bid. The volume. Oh, corn. That's disappointing. No corn. Oh, my dear sweet wife is bringing me some nice hot tea. Did you guys see my other mug? This is my cold tea. Look at that guy. That's it. Put it right in front of my face. There we go. That's me. That's me as a trader. And I'm double fisting it. All right. Got plenty to drink. Ooh, that one's hot. Burned my mouth. Okay. All right, so we could come in here, but because there's not any good open interest and volume on the options, we're not going to do an option strategy. I'm not even going to attempt, and I ain't going to show you. But we could have put an iron condor on here, or an iron butterfly. But that would be a good setup for an iron condor and iron butterfly. But there's no options, so we can't do it. Okay, so you just have to not buy some corn that day. Go buy corn. That's what it's saying. All right, this is very low. So there you go. So what about silver? Silver and gold. Low. Not very low, just low. Let's go look at silver and gold. All right, so we'll come back over here to charts, and we're going to look at silver and gold. Silver, we know has been going to the moon, right? Comex silver. This is the January contract. It's getting, oh my gosh, look at that thing. Look at the March contract. Look at that. It doesn't like it. It doesn't like it. Doesn't like it. Not me. Doesn't like it. The AI system doesn't like it. Let's turn on the bulls and bears. I don't want that. I want this. Bulls and bears. All right. It's coming into a wedge pattern up in here. Isn't it? Right off those blue lights. Fibonacci that thing. Fibonacci that thing right there. Put a Fibonacci on that thing. Fibonacci says down here. What? Why are you showing me that while I'm teaching my class? Why are you showing me that while I'm teaching my class? My wife comes in, she starts showing me things on Facebook. Did you forget I was teaching a class? You just brought me a drink. It's okay. They don't care. You want to come say hi? No? Okay. She forgot I was teaching a class and had to show me something. All right. Okay, here we go. So Fibonacci, that thing, 38.2, 61.8, all the way back to 60. Where do we think that silver is going to come back to? Well, it doesn't like it for the long position. Let's go look at this again. See, it's bullish. Low bullish. These are all bullish. Oh, there's a bearish. Natural gas. See, it's interesting because it can come in through here and it can say this is low for bullish, but it might be high for bearish, but bearish didn't show up in here. So if it's low for bullish, well, that might be high for bearish. So if we look at silver and gold, it thinks, the AI system thinks that this thing's going to come down back into the Fibonacci sweet spot. Everybody would like that because then you could buy some gold down in here and anticipate a rally next, the rest of the year. So that's maybe, I don't know. That's silver. Let's go look at gold. Gold, gold, gold. Everybody loves gold. All right, there's February gold. Come on. All right, so we're going to turn off this one here. And we're going to turn on the bulls and bears. All right, so it too is going into a little pattern like that. Same little pattern, all right? Little triangle wedge pattern. Oh, that's going way back. So there you got a natural trend line coming up there. You got a resistance across the top. That is a setup for a fall. Now, is it going to fall or is it going to break out the top, come back down, and continue higher? Nobody knows. But seasonally speaking, between January 9th and January 27th, 83% of the time over the last 12 years, 34% return on that thing to the bullish side. But when the AI system looks at it, it says, I don't know if it's going to do that again. It says that's a low probability that that's going to go again. January 9th to January 27th, 83% of the time over the last 12 years, that thing's increased by a 34% annualized or a 34% return on margin. $3,000 move. That's what it's saying. But it just doesn't think it's going to do it again this year. Starting tomorrow. It's already got 1, 2, 3, 4 bars. We generally like to see like 4 green bars, right? And then a little pullback, couple yellow bars when we're using the bulls and bears. And then the first green candle to make a new high. That's the one we want to get in on. So let's watch that. A lot of green on this gold. But you can see the. All right. That's what we're at with gold. Let's go look and see what else it's got going. Okay, we're running out of time. Corn. Let's come in here and pull up let's go over to our portfolio. And let's have it choose what it likes. We're going to say 3, and we're going to pick one at a time. They don't have to be selected here, auto select. So its favorite, to the bearish side, starting January 15th, is natural gas, bearish. Out of the 82% of the time over the last 11 years, natural gas has fallen in price between January 15th and January 27th. 82% of the time. Let's go look at nat gas between January 15th. So natural gas. Gas, natural gas right there. There's the February contract. It's almost ready. Should we go out and look at the March contract? Wow, look at natural gas. Tumbleweed. Chart overlay, bulls and bears. Let's turn off this little ATR here. Wow, look at that. Beautiful little ABC pattern. Well, it certainly doesn't think it's going to get a big rally. That's all it's saying. It doesn't think it's going to get a big rally. It says it should continue to fall. I don't know. It looks like the fall's already happened. I would expect some sort of a little, maybe a little, I don't know. This could be like a little head and shoulders down in here. Get something like this going. Or we could get another, this is the first drive, second drive. We could get a third drive down. If it does, we'd have to move this all the way down. That would be your left shoulder, wherever that bottoms out. We get a head down here and a right shoulder. That might be what's going to happen here. So we get a drive 1, counter trend, drive 2, counter trend, drive 3 down to the head. And then we would anticipate maybe the reversal and turn around and we get a little bullish rally out of it coming out of this side. Don't know. Nobody knows, but this thing says that it likes it for the short side. It's already got a nice short side, but that's not the timing on this is not until January 29th. Is that, oh, down here, January 15th. January 15th. It's only the 9th right now, right? It's the 8th. So the 15th is out here. So maybe what we'll get is in there, we'll get a little rally, and then the first red candle, that would be the one to go. Can we do options? No, no options. Volume and open interest, nothing. So we can't trade options on it, but we could day trade it. We could come in here and say, well, this thing's bearish, 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 and we could go in and do a little day trading with our bearish bias to the downside. Take some short positions in here. We could go into the micro mini or into the mini. So this is the natural gas full side. We go into mini right here, and then we wouldn't be risking so much money. They don't have a micro mini, just a mini. That's the one you want to trade anyway. Let's go look at the options on the mini. Oh, no options available. That sucks. How much is that? From here to here. That's $1,200. And what's the day margin is $500. The initial margin is only $1,000. And then maintenance margin is $1,000. $1,100 to $1,000. That's easy to trade right there. That's a $1,000 position, and you can hold that for multiple days. Yeah, you could. That right there, that moved from this first red candle. Let's say you got into the close of the first red candle, got out on the open of the close of the first green candle. That was a $2,000 move right there. Just following the green colors. Let's go ahead and look at the bulls and bears. Bulls and bears. There you go. Little neutral zone in there. First green candle, red candle, boom, down it goes. Remember, that neutral zone is the Fibonacci. That's your Fibonacci sweet spot. So that's how you do a Fibonacci projection. You lay your Fibonacci number over the top of those yellow bars, because that's from the top of the peak. Yellow bars is the Fibonacci number, 61.8 to 38.2. And then this number down here, that line right there is the projection of where it's saying, based on Fibonacci, that's where they think price is going to go. From here, yellow, through the zone, and then the next drop is down to that line right there. And then, of course, you have Fibonacci extensions. So you can turn on your Fibonacci extensions or predictions. Let's see which one it is. Predictions. And then you can come in here and you put this one. Oh, it's this one. We move it right to the 50 or the 61.8. If you put it on the 61.8, then you get a prediction right here. Look at that. Man, nailed it. That baby is traveling on the Fibonacci sequence just like a train on rails. Look at that. Holy cow. Better learn your Fibonacci numbers. That's how it works. Those are just a little simple ruler. It's just a ruler. All right. Just a ruler. Learn how to use it. All right. That's it. That is natural gas. Let's go look at one more. We got some time. We got one more. We're running over a little bit of time here. Let's add a couple more. Let's go in. Let's say we're going to do, let's do 5. 1, 2, 3, 4, 5. Yeah. So they're going to give me 4. Must not have a, oh, because I already got one. Okay. Auto select. All right. Get your cameras out. Get your cameras out. Start taking pictures. All right, so we got lean hogs. Lean hogs in there twice, and that's not fair. Land, give me one more. Auto select. All right, we got lean hogs in there twice. Got natural gas, gasoline. Oh, it put corn in there, January 12th for bullish. Very low. Well, it is what it is. If you want to do these calculations yourself, you can go get TradeMiner Pro over at trademiner.com. Get this little piece of software for yourself. It's a really cool little piece of software. It's very helpful, and you can do this yourself. All right, that's all I got for you today, guys. I'm going to come in here. I got a couple little fun things to show you. I got a big announcement coming for Pit News Magazine. Big. One of the biggest announcements for Pit News Magazine. I can't tell you right now, though, so make sure you keep coming back to all of my classes because I'm going to making a big announcement for Pit News Magazine. You're not going to believe this big announcement. It's a big announcement. All right.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, and also TradeMiner Pro, TradeMiner, TradeMiner.com, TradeMiner.com to get the TradeMiner software, and then you can come along and work along with me, and we'll do this again soon. It's been too long since we looked at the seasonal nature market, but of course in Pit News Magazine, every month we have the seasonal nature market. We do a bunch of seasonals for you, and we do this analysis, and we put the best ones in there so you can look at the seasonals in Pit News Magazine. So follow along, and we will see you guys. Today is Thursday, so no class tomorrow. We're going to see you next Tuesday. Will be the next class, Tuesday morning, 9 o'clock, bright and early, and we will do it again. We're going to look at we're going to be looking at our UBI, Universal Basic Income, high return portfolio, high ETF, or ETF, high dividend, high yield portfolios, and we were working with that, trying to decide where to put some of our money because we've been getting dividends. We got a big bunch of dividends already come through, so we got some money we got to allocate. So we're going to talk about where to allocate our money. We've also got some money that's sitting on the sidelines because of our tax loss harvesting, so we can't get back in for 30 days on those. So we're waiting, and I'm getting a little anxious because some of the markets are really taking off like rocket ships, and I can't get back in. It's frustrating. All right, so that's where we're sitting. We'll do that on Tuesday morning at 9 o'clock. We'll see you then. Take care.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pit News Magazine.
Oh yeah, definitely subscribe to Pit News Magazine. You'll thank us later.